Welcome back, traders, to part 2 of our comprehensive guide to mastering the basics of Forex trading. In this segment, we'll dive into the core of the foreign exchange market, also known as Forex or FX. The foreign exchange market is the largest financial market in the world, where currencies are bought, sold, and exchanged. Unlike centralized exchanges, Forex transactions happen over the counter through a global network of banks, brokers, and financial institutions. Forex trading is all about making money from the fluctuations in currency exchange rates. These rates are influenced by supply and demand dynamics. A currency's value increases when demand is higher than supply, and decreases when demand is lower. Prices in the Forex market fluctuate due to economic, social, and political events around the world. Factors like employment rates, inflation, and the overall economic performance of countries play significant roles in these price movements. Governments and central banks, such as the European Central Bank, the Bank of England, and the Federal Reserve, are key players in the Forex market. They control inflation, manage money supply, set interest rates, and oversee commercial banking systems, all of which impact exchange rates. When you trade Forex, you're essentially investing in one economy against another. For instance, buying US dollars with British pounds means you're betting on the US economy outperforming the UK economy. A currency pair consists of a base currency and a quote currency. For example, in the EUR-USD pair, the euro is the base currency and the US dollar is the quote currency. A quote of 1.1302 means 1 euro is worth 1.1302 US dollars. Currency pairs are categorized into majors, minors, crosses, and exotics. Majors include pairs like EUR-USD and USD-JPY, representing highly liquid and stable economies. Minors, such as GBP-CAD, exclude the US dollar, while exotic pairs combine a major currency with one from a developing economy, like NOK-TRY. The main goal of a Forex trader is to buy currency pairs when exchange rates are expected to rise and sell them when rates are expected to fall. So why trade Forex? Here are a few compelling reasons. Firstly, during a global financial crisis, while stock markets and real estate may suffer, Forex remains stable because currencies are traded in pairs. When one currency declines, another rises. Forex trading can be highly profitable. Successful trades can yield significant returns, but be aware of the risks. Incorrect predictions can lead to losses. Forex trading is highly accessible. You can trade from anywhere with just a computer or smartphone and an internet connection. Forex is the most liquid financial market, with over $7 trillion traded daily. It operates 24 hours a day, 5 days a week, ensuring there's always a buyer or seller whenever you need to trade. Thank you for joining us in part 2 of our Forex trading series. Stay tuned for more insights and strategies in our upcoming videos. Don't forget to subscribe to our YouTube channel, share it with your friends and family, and let's continue this journey towards financial freedom together. And be sure to watch out for part 3 of our series, where we will discuss what is a Forex broker, trading times and trading sessions, take an exercise, some Forex trading principles, and some Forex terminologies. See you there.